So welcome, guys. This is the first episode of the Investors Lens. It's the second. It's the second part of the 100 days challenge. Three part videos. We did the first one with Jonas, and now we're here with Lusimadio. And I'm not really going to speak for him. I'm going to let him introduce himself. He's a really talented young person from South Africa. Lusimadio, if you can tell the people about yourself.
Yeah, I don't know. First of all, thank you very much for bringing me in the call. I appreciate it a lot. It's always good to share our knowledge with the community and see how do we empower each other. Thanks a lot for bringing me on the platform. So for everybody who doesn't know me, I'm Lusimadio, and yeah, I mean I'm an entrepreneur. That's just what it is, and been working back to back with both entrepreneurs and also bridging up with investors, understanding the many other aspects of working in the financial space, economy. So I think this is just my life. I've been working in different environments. But there's so much more to know about me. I always tell people, go to Google, type my name, and you'll find whatever you want to find. Yeah, that is it.
This man is being very humble. He has a lot of things going on. I'm just gonna let you do the googling for yourself. You guys should find out who exactly is. So this week is the first episode of the Investors Lens. This is episode one, and we're going to really go into the investor's mindset. What kind of mindset should you have? I'm not talking about you, the young people. I'm not the young generation actually looking for investors, but I'm putting you in a perspective of you as the investor. At the end of the day, young people these days, we're not really asking for money. We are asking to invest somewhere. And which kind of mindset? Luis Mario has a wealth of experience throughout his years. Which kind of mindset should you have going into an investor space? So the first question I'm going to ask: what psychological framework, what mindset should you be in to differentiate an investor from a gambler? Yeah.
Okay, that's a very nice question. I think, I mean, there is a whole difference, like investor and a gambler. Just by looking at the concept, it's very different. So they are not the same people, right? No one should consider themselves a gambler because they are betting into a business that have maybe no future. Let's say that, or maybe trying to buy a share or get into forex exchange, for example, or trading crypto, then maybe you think that by doing that you are a gambler because you're betting in something that you don't exactly know if the market's going to go up or it's going to go down. You know what I mean? So I think the biggest difference between an investor and a gambler is that an investor, he uses a probabilistic mindset, but a gambler, he bets on his own intuition.
Oh.
Right. So that's like, I would put it as the main difference. It englobates everything. So a true investor will never invest into something that has high risk, and he takes that risk without calculating the amount of consequence that is going to get out of that, which makes an investor someone that is way more informed and knowledgeable about the space than a gambler who just feels like, let me try this, maybe it's going to work for me, right?
Maybe.
So yeah, so that's the difference. So I think from that perspective, you see that an investor would find, like, for example, a business idea, and he would try to understand what the business is all about, what the returns, trying to ask questions, because they want to have a proper, clear understanding of what the business risks are before they actually get their feet into the door or in the house. which is different with a gambler. A gambler would never do that. A gambler would just wake up in the morning and say, I'm going to bet. You know, I'm gonna try this. Yeah, maybe some of them they use luck, you know, as a backup, because they say maybe they have a luck, some kind of things behind it, because they believe that can work for them. But in the investment space, you don't gamble. You don't. You just don't gamble. You have to be knowledgeable. That's why the best investors in the world, they know exactly what they're investing in and the realities of the industry.
You've actually shifting into the next question. As an investor, the concept of discipline, patience, outperforming emotional buying. How does discipline and patience outperform emotional impulse buying, like in the long run?
Okay, so on this point, it's important to understand one thing. When it comes to understanding market, right? Market is an environment that is never stable, right? You never be in a market where everything is constant, like, you know, whatever is happening. Even for those who work in the stock market, they will always tell you that it's not predicted. It's not predictable. You don't predict whether the market will go up or will go down, or whether a stock will lose value or will gain value, right? However, this is something that has made many people actually make more money than others. It is their ability to be patient and be persistent, right? So an investor, if you want to succeed in an investment space, you have to be patient and you have to be persistent. Why? Because it shows that you are knowledgeable about the industry.
Can you like give an example where like discipline and patience helped you, so that people can know in terms of yeah.
Okay, a very I wouldn't even give example of myself, but I will give something that is very common in general that everybody will be able to relate to, right? It is when you are in a trade market, for example, right, and you have stocks. You go, for example, for MTN, for example, and you buy stocks of MTN, right? And then we have all these very big issues going on in the economy, some microeconomy going around, like inflation in Kenya, for example, right? That will directly affect the price of the stock, correct? So now, the thing is, when the stock price goes down, right? If you bought the stock for, let's say, for example, 1,000 in the Kenyan currency, for example, 1,000 in the Kenyan currency, and then at some point the market goes down, and then you lose that your share or your stock loses value. So maybe let's say those values for 10, 20%, it goes down, right? So now at that time, you as the stock owner, you're gonna say the stock is going down and I'm losing money. What would be your first action as an investor, right?
Yeah.
As an emotionally driven investor, your first action will be to sell the stock.
Just go. Just do.
Right? Yes. So because you are acting out of emotion, you are so emotional, you don't want to lose the money, and you say, I don't want to lose everything because I'm already losing a lot of it. I need to get my money back, right? So now you'll sell the stock, and then later on the stock goes up. Now you don't have enough money to buy that same stock because the stock now is above the money that you have actually sold it for. Right? Yeah, so now, a persistent and a patient and a very well informed and trained investor would not do that. Right? What he's going to do is he's going to keep his stock for the longest term as possible. Because he knows that it's a market, it can go down, it can go up, and you know. And by the way, even if your stock price goes to zero, you still own the stock.
You still own the stock.
You understand? So that means anytime the market will change and your price, the price of your stock will skyrocket, right? But now, when it comes to buying and selling, for example, because I mean, for those who know trading very well, you know that you have to press buy if you want to buy a stock or sell if you want to sell the stock, right? So now, when it comes to like making a decision on buying a new stock, most people will buy new stock when the price of a stock is higher because you feel like, oh, because the price of the stock is higher,
Stock is
it
going high.
then, yeah, you know, so you're gonna make more money. You understand? So now, a very well informed, trained, a patient, and persistent investor will preferably buy the stock when the stock price is lower.
When it's,
You get a different
going down.
Correct.
Yeah.
So at that point, it means that you, as an investor, you are able to buy a stock in a lower price because the market is working in your favor. So instead of deciding to sell your stock because your stock is going down in the price, buy more, accumulate more. Yes, correct. So that's what the idea is when it comes to being persistent and being patient. And also on this point, it's like you enable yourself to earn more and to be able to access opportunities that you could not access it if when the market was on top. So that's the same thing. It happens. The same thing on the commodity space. Everywhere, it's the same idea.
Even in real estate, I saw this movie in terms of thinking big, where guys went and made down payments on apartments that were run down, and then decided to renovate them, and then put them in a new settings, and then sell them in terms of mortgages.
Correct.
Which I mean, I thought that was amazing. That's actually even get to that was there. Now the next question. Now we see discipline and patience outperforming emotional buying. Now, what practical tips can you help replace? Can you advise guys to replace that emotionally driven decisions instead of process driven decisions? Yeah.
In terms of practical tools, right, or practical tips,
yeah.
I think every investor needs to have these few very important things, right? Number one, you have to have your investment checklist. Have a like a book where you write all your investment goals, like what you want to invest on. That's so number one.
One investment checklist can vary from the other. Like if it's stocks, it's different. If it's real estate, it's different. If it's agriculture, it's different.
Well, not really, not really. Like you have to create 3 different or 4 or 5 different types of checklist. Not really that, but have like, you know what we normally do is like a to-do list. You know what we call that to-do list? You have a list of everything that you want to do for the day. That's how you do it. You do the same thing with the investment. You do an investment checklist. So that investment checklist aligns exactly what investment you want to do, when you want to do it, how you want to do it, how much you need to save in order for you to get to that level of investing in that specific type of investment. So you have that investment list so that you can follow with it as you go. You follow with it as you go. Number 2, you need to have a portfolio allocation framework. How are you going to allocate your funds, for this investment? Don't just invest. Like, for example, in finance, there's something that we learn, which is that the best way to compound or to increase your returns and profits on investment is by allocating diversified. Find a portfolio, because when we call a portfolio or an investment portfolio, it means it is a room of different types and levels of investment, right? So you have to have that. Don't just choose one. Have a portfolio.
So spread Spread your risk.
Fantastic. Spread it. Spread investment across. But always, I advise this. If you're finding investments to spread on, always try to find investments that are lucrative. Okay, number one, must be lucrative. Number two, the risk level is lower. Okay,
The risk.
especially this is like especially for those who are starting in the investment space, not for those who have too much money to spend. But if you have a very, concealed amount that you have to invest, find investments or create a portfolio of investments that are, first of all, low risk, and number two, high profit.
Low risk, high profit.
Yeah, it has to provide you low risk and it has a high return, right? And most of this type of investment would fall under real estate, for example, bonds, mutual funds. It will fall under those categories, right? And then you know exactly that your investments are secure. You're not going to do crypto or trying to do trade exchange, like, or how do you call it, currency exchange on Meta Trade 5 or something. So you don't want to do that. And myself, I always advise sometimes it's more preferably for me to buy stocks than to do forex exchange. That's a point I'm making. That is a token for current investors or new investors. If you want to start, better do stocks. Don't do forex exchange.
Actually, when you say that, it's, you see, I even started doing this interviews last year, I had a 30-day investment challenge. So where there's a platform where they offer sort of like a mock-up to invest in the stocks in Kenya. So last year alone, the stocks in Kenya made over 1 trillion in profit. Yeah.
Okay.
So like, and it's less volatile as compared to forex, because forex, there are too many variables involved. Especially now, you find, let's say, like the Mrs. Watanabe in Japan has made some decisions that affected the Wall Street guys in New York. And then the guys in Helsinki have made a policy that affects somebody in Australia. So like trying to correlate all those different informations can become like really hard. But that's, that, guys, you gotta invest in stocks, especially stocks than forex. That's amazing. So when you're looking in terms of now, instead of what's it called, the practical tips, your high low risk and high return in develop. Now, how do you develop a long-term vision that withstands like short-term volatility based on the practical tips that now you've offered?
I'm gonna give 4, right? I mean, we know exactly that when it comes to investment, either building a company or investing in a company or in anything that you would like to do, there's always microeconomic factors, and there are also the macroeconomic factors, right? So now when it comes to your macroeconomic factors, they look at a general vision of the economy of a country, right? Now, the thing is that when you're building a portfolio of investment, or when you want to start investing, you have to, like, there's no way you become a powerful investor if you're not aware of the environment. It's just not going to work. So understand the macroeconomics around your investment initiative, right? Understand that, like, have a good feel of what could affect your business or your investment in the future. right? So you need to have that. Number two is have a clear investment direction. Like, don't just invest because you feel like, oh, I have too much money, now I want to invest. And then you jump into any type of opportunity to invest in. No, have a clear path of why do you want to invest? Where do you want to invest? For how long? Is it a short term or long term? You know, um, what style of investment do you want to apply? You know, so you have to have that very clear. And number three, you have diversify it, like invest in different portfolios, have different type of investment, right? And now, and then lastly, I will always put a defined time horizon, period, as I said in the beginning.
Yeah.
If I'm investing in real estate, for how long? You already know real estate is a long-term gain. You cannot invest in real estate and wait for a return in the next 2 weeks. Not gonna work. It's a long-term gain, right? You have to wait for at least 6, 10 years,
Yeah.
15 years, 20 years for you to actually see, benefits from your real estate investment. Um, and then you have, like, for example, if you're investing on stocks, it's a long-term gain. You have to wait, you know. But yes, there are short-term investments too. So at least you, as the investor, you have to have these four things in mind, you know, so that you have you exactly develop a strategy that is going to outstand the taste of time and circumstances that might occur in your economic environment.
Yeah. So you you said that the long term, like stocks and real estate, is long term. Now, how much does the I usually hear people say technical analysis, and technical analysis is usually mostly data driven. How much in the investment space does data play how what role does data play in overcoming fear and greed in investing? As a last question. Mm.
I mean, data plays a key role everywhere.
Yeah.
Data is the mother of everything. You know why in Africa we are suffering? It's because of
Yeah.
data.
Yeah, we don't have data. It's like a black hole.
It's data. Data is the motherboard for everything that we can build in this life.
Yeah.
And this is why the youth, and I will target the youth right now and to say that we should not be emotional when it comes to investment. We should be very knowledgeable about our economic environment. There are businesses that won't work in certain parts of Africa, right? There are investments that you will never see as much benefit in certain parts of Africa because you don't have access to data.
Yeah. Yeah.
In Africa, for example, the internet space is crying. Why? Because of lack of electricity, stability, right?
Yeah.
And you can't get data if there's no power available. Now you want to start a tech company and you rely on data,
From other
and
places.
the internet doesn't provide you enough data for you to actually expand your business.
Yeah.
How do you think you're going to make it? Right? So finding the best ways to get data. Now, even as Africans, we are relying on European, American, and Asian data to predict how the business will do in Africa, which is bad.
Yeah.
Now, let's work on investment strategy. Build it under data. That's just the main point. Build it under data. Find information, even if it is a primary data or a secondary data. No problem. Just find a data that can back up your strategy. There's enough information out there, many newspapers out there that are focused on finance, trade, focused on investments and stuff like that. So read your newspaper, go follow, sign up on this newsletters and stuff like that, so you can get information. The more knowledge you have about the environment that you are in, the better decision you're gonna make when it comes to investment strategies.
Yeah. Thank you so much. I think for when it comes to data, I always stress the fact that Africa is a black hole for data, because we store our data somewhere else, which I still don't understand why till today. Our data is usually analyzed by other people from other continents, instead of being analyzed by us, which is it's something, as you whoever is watching this, as a young investor, please put in mind that we need our data in Africa. We don't need our data being sent to Europe. We don't need our data being sent to China. We don't need our data being sent to America. We need our data here. We need to use our data to, like as Lusimadio has said, we need our data to actually, it's the motherboard of everything that we're going to build. Lusimadio, thank you so much for your time. This is episode 1. No, maybe too much sec. I'm so excited. I'm so excited that you actually came. In spite of everything that's been going on, at the end of the day, even here in Kenya, we have electricity problems, but at the end of the day, we have to make it happen. Thank you so much for your time. We hope to see you now for episode 2. For guys, be with us the whole week. In case you have any questions, any suggestions, any questions to Lusimadio, I'll definitely put his social media down there, and everything that you need to find out about him, I'll definitely put. Thank you so much, Lusimadio, for your time. And any last words before we close this first episode?
I mean, thank you very much for this. I'm quite excited to continue to the last day, and yeah, let's keep on improving ourselves, sharing knowledge, and empowering others.
Thank you so much. Thank you so much, guys. So see you again for the next episode. Yeah.
Thank you.